Are you looking for long-term investment strategies that provide steady growth? Building wealth over time requires more than just short-term gains. It's about creating a well-diversified portfolio that consistently grows. In today's video, we'll explore 5 long-term investment plans that can help you achieve sustainable growth, even in volatile markets. These strategies focus on adjusting traditional allocations and tapping into emerging megatrends that offer stability and steady returns. Whether you're looking to safeguard your wealth or capitalize on future growth, these methods are designed to build your financial future without constant attention. Let's dive into these proven strategies and get you started. 1. The modern 60-40 digital and real assets. The traditional 60-40 portfolio, 60% stocks and 40% bonds, has been a popular strategy for many investors. But in today's economic climate, it's showing signs of strain. With interest rates rising and bonds becoming less attractive, it's time to update this approach. The modern 60-40 strategy replaces the bond-heavy portion with a 60% global equity and 40% alternative mix. The equity portion includes a diversified selection of stocks from around the world, ensuring you're capturing global growth while managing risk. The alternative portion is where the real innovation happens. Instead of traditional bonds, you focus on private credit, infrastructure funds, and even a small slice of Bitcoin as your digital gold. Bitcoin has gained significant traction as a store of value and a hedge against currency devaluation, a role traditionally played by gold but with a digital twist. This provides an additional layer of protection and diversification against inflation or economic uncertainty. Private credit and infrastructure funds offer steady, long-term returns backed by tangible assets like toll roads, energy infrastructure, or renewable energy projects. These assets often generate cash flow through dividends or interest payments, making them attractive in a low-interest environment. By combining global equity with alternative assets, this strategy offers a balance of growth and protection, helping investors achieve consistent returns while minimizing risks during market downturns. It's a modern, flexible approach designed to build wealth steadily over time. 2. The technological megatrend ladder. The tech sector has always been a driving force behind economic growth, but betting on just one tech stock can be risky. The volatility in the tech space, combined with the fast pace of innovation, means individual stocks can see rapid fluctuations, making it harder to predict future success. A much safer and more diversified approach is to build a ladder of thematic ETFs that focus on long-term, emerging technological megatrends. These megatrends represent industries that are poised for massive growth over the next 10 years and beyond. Examples of these high-growth sectors include generative AI, cybersecurity, and precision medicine. Rather than trying to pick individual stocks in these sectors, investing in thematic ETFs that track these broad, rapidly evolving industries helps you capture growth across the entire sector while spreading risk. For instance, generative AI is expected to revolutionize sectors like healthcare, finance, and media, providing breakthroughs in areas like drug discovery, personalized financial services, and content generation. As these technologies continue to advance, early investment in a generative AI ETF gives you exposure to a broad set of companies leading the charge in these innovations. Similarly, cybersecurity has become an increasingly important area, especially as more industries and individuals move to digital platforms. With rising threats to data security, companies that specialize in cybersecurity services are experiencing sustained demand, making it an essential sector to include in your portfolio. Meanwhile, precision medicine, which focuses on tailoring treatments based on genetic data, is transforming healthcare by offering personalized treatment options that are more effective and efficient. The real power of this strategy lies in its flexibility. By rebalancing your portfolio annually, you can adjust your exposure based on which sectors are accelerating. This means you're not locked into a single area of tech, allowing you to adapt to changing trends and technological advances. If one sector faces a temporary setback, your other investments in the portfolio can help cushion the impact. In this way, you're effectively betting on the industries of the future while avoiding the risks tied to individual company performance. 3. Global demographic shift investing. Long-term wealth is shifting toward emerging markets, particularly those outside China, such as India and Southeast Asia. The growth of the middle class in these regions is one of the most significant demographic trends of the 21st century. As millions of people in these countries move into middle class, their demand for goods, services, and technology will skyrocket, driving economic growth and creating wealth-building opportunities. To tap into this growth, consider investing in broad market ETFs that focus on these regions. These ETFs offer exposure to the rising middle class in countries like India, Indonesia, Vietnam, and Thailand, countries where economic development is happening at an exponential rate. By investing in these markets, you align your portfolio with the growth of emerging economies that are poised for long-term prosperity. Unlike developed markets, which may be facing slow or stagnant growth, these regions offer high growth potential thanks to their rapidly expanding economies and youthful populations. As these regions become wealthier and more urbanized, their consumption patterns will drive innovation and demand for new technologies and services. By focusing on demographic shifts and investing in these emerging markets, you position yourself to profit from the rise of the global middle class. Over the next 20 years, as wealth in these regions continues to grow, your investment in these markets can provide substantial returns. 4. Green infrastructure, cash flow. As the world transitions to more sustainable energy sources, the demand for green infrastructure will skyrocket. Unlike the often volatile nature of green tech stocks, like electric vehicle companies or solar panel manufacturers, green infrastructure investments focus on the physical assets that support the energy transition. These include utility-scale solar farms, battery storage facilities, and smart grids. These investments are typically backed by long-term government or corporate contracts, providing a steady income stream similar to what you'd expect from real estate investment trusts (REITs). For example, a solar farm might receive guaranteed payments from a utility company over 20 years, making it a reliable source of cash flow. The beauty of green infrastructure is that it's less volatile than investing directly in individual renewable energy stocks. With the global shift toward sustainability, investing in green infrastructure offers consistent dividends and long-term growth. As governments and corporations invest heavily in building a more sustainable future, the assets in these sectors will continue to generate predictable returns, making it an ideal long-term investment for those seeking to profit from the energy transition while managing risk. Additionally, these assets offer a hedge against inflation, providing stability and protecting your investments from economic fluctuations. This makes green infrastructure an attractive option for investors who want consistent cash flow with a positive environmental impact. 5. The anti-fragile dividend growth plan. If you want to build wealth over the long term while managing risk, one of the best strategies is focusing exclusively on dividend growers, companies that have consistently paid and raised dividends through every recession. These companies have proven they can not only survive difficult economic conditions, but also thrive, making them a solid foundation for long-term investment. They are typically well-established, financially stable, and committed to returning value to shareholders, which makes them a reliable choice for investors seeking stability and growth. The key to the strategy is using a dividend reinvestment plan (DRIP) to automatically reinvest your dividends back into more shares. This strategy becomes particularly powerful during market crashes when stock prices drop. When the market goes on sale, your reinvested dividends allow you to buy more shares at a discount, which means you benefit more when the market recovers. Over time, this compounding effect accelerates wealth accumulation. The anti-fragile dividend growth plan takes advantage of market volatility. While others may panic and sell during downturns, you'll be collecting more shares at lower prices, strengthening your position. This approach is particularly attractive for long-term investors who seek stable income and capital growth, ensuring that your wealth grows steadily while providing you with the opportunity to buy more shares during market dips. By embracing the strategy, you not only secure consistent returns, but also position yourself for significant long-term wealth generation. There you have it, top 5 long-term investment plans for steady growth. From a modern 60-40 strategy to investing in green infrastructure, these plans offer a diversified, stable path to building wealth over time. By focusing on long-term growth and minimizing risk, these strategies provide you with steady, predictable returns that allow you to grow your portfolio without constant market stress. If you found this video helpful, don't forget to like, share, and subscribe for more investment tips and insights. Let me know in the comments which investment strategy you're most excited to try. I'll see you in the next video.